All right, guys, welcome to Stock Talk with Nico Kritikos. Today, we are going to be doing some stock analysis for Cadence Design Systems. This is a stock that I've been watching it the last couple of weeks, and then I think today I bought a couple shares of it just to get a position started. We're going to go through the valuation and stuff, but the stock's up 48% on the year. So I feel like, maybe it's a good time to buy it. The valuation's not bad. We'll look at it, but it definitely, if we do have a pullback in the market, we definitely can see the stock come back. So it's kind of complicated to explain what the stock does, but this is probably the best way to describe it. So Cadence is a pivotal leader in electronic systems design, building upon more than 30 years of computational software expertise. The company applies its underlying intelligent system design strategy to deliver software, hardware, and IP that turn design concepts into reality. Cadence customers are the world's most innovative companies. This part's interesting, delivering extraordinary products from chips to boards to complete systems for the most dynamic market applications, including hyperscale computing, 5G communications, automotive, mobile, aerospace, consumer, industrial, and healthcare. So that's very interesting. So it's kind of a vague description, but I mean, they're making hardware, they're making software, and I saw one of their competitors is Palantir, so maybe that gives you a better idea. But the interesting part is that their customers are some of these innovative companies that are making chips, and I know they're partnered with NVIDIA, they're partnered with Intel, so that kind of gives you an idea of what they do. But the thing that really drew me into this stock was the financials and a lot of the characteristics of this company. So we're going to go down my checklist here, and we're going to see what is so good about this company. So number one, is the revenue trend strong? Absolutely. If we look at the chart here for revenue, you can see it's super, super consistent. This is always what I'm looking for when I'm looking at stocks. I'm looking for where are these companies that can show consistent revenue growth? And this is one of them. From 2010 to 2024, now for 14 years now, you can see consistent growth. They're growing at 10, 11, 12%, 13% a year. And the interesting thing is the growth actually picked up from this era to the last 5 years into the last 2 years. The growth is speeding up. And right now, with the artificial intelligence boom just kicking in, this whole semiconductor chip and AI space is really just exploding with all these companies benefiting from it, whether that's the chip makers, whether that's the software makers, whether that's the Google, the Tesla, the Meta, Adobe. There's so many companies that benefit from it. So anyways, the point is consistent growth. Last year they did $4 billion of revenue. Keep in mind, this is a $81 billion company. So this is not a traditionally cheap valuation, but we're going to get into that in a second, because there's a lot of times there's a reason why stocks trade at high valuations. They're not always justified. They're not always healthy. But in this case, this one looks a little bit more appealing. So then we get into the net income. Net income also looks awesome, averaging 24% growth. Let's scroll down here a little bit, and we're going to see a similar thing. So they were losing money up until 2011, and then since then they've been profitable. So the last 10 years, we're looking at about 24% growth on average for this company, net income wise, and they did $1 billion of net income. So out of $4 billion of revenue, a 25% margin, that's super good. That's really strong. So that's good. And net income is going to get a check there. And then we get to the PE ratio. Now, this is where it gets a little bit, I don't want to say scary, but it gets something to keep in mind. So it's trading at 50 times earnings, right? We can go to the top here. I got two things. So this says this is trading 78 times trailing earnings, 50 times forward earnings. Okay. Now let's go to this one, and it's going to show us where it trades at the last couple of years. So this shows us we're trading at 78 times earnings. Okay. Trade on a trailing basis. So trailing, and keep in mind, they did $5 EPS last year. They're supposed to do $6 this year, and then $7 next year. And those should pretty much be pretty accurate, because you can see here they pretty much usually come in right around those numbers. So just keep that in mind. EPS is still growing pretty strong, and 50 times earnings. I mean, 78 times earnings is a lot. 50 times forward earnings is a pretty, that's kind of a lot. That's kind of a lot, but you have to think of it like, look at where the stock normally trades. This stock normally trades at, 50, 60, 70 times earnings. Okay. I would say probably 60s right in the middle. And there was a period here, around the pandemic, it was trading at 20 or so, but that, who knows if we're going to see those valuations again. Could it come to a 40 or a 45? Absolutely. That's much more realistic. If things got bad, I could see a 45. So, anyways, the point is 50 times is really not that bad. As long this company's been growing for 14 years and all the financials, everything looks great. The space they're in looks great. The companies they work for or work with looks great. So I'm having trouble finding a downside here. I mean, again, is the valuation as cheap as it could be? No, not really. But again, with stocks like this, when you have really strong companies, sometimes they don't fall a lot. So some companies just they don't have big drops because the company is usually doing great, and they're usually, as long as they're putting up good numbers and they don't have bad news, some stocks can just kind of keep going. Are they innovative? Yes, absolutely. Strong market share. I saw 73%, I believe, right here, but that was only for. It says Cadence Design has a market share of 73% in creative design services, competes with other companies like Palantir. But then I read another article that said that overall they have 11% market share. That sounds more right. And then again, the whole market share thing is kind of like it's hard to describe because it depends what you're talking about. If you're talking about a software, well, there's different types of software. So they have what percent market share in what software categories. That's where it gets kind of it's not so black and white, right? There's a middle ground there. Return on invested capital is 31% and climbing. This graph also looks fantastic. Let's come down here. In the last, since 2019, it's gone from 18% to 31%. That's outstanding. You can't ask for more than that. And if you go back to 2015, it was only 11%. So they've more than tripled their return on capital, or they've roughly tripled their return on capital in the last 9 years. 8 years. No, 8 years they did that. It's phenomenal. It's just the consistency is there. The numbers are there. Like everything is there. I'm not seeing anything wrong. Growing equity, yes. Let's go to the equity here. We're going to see 2.4 billion 4 years ago. Now we're at over 3.4 billion. Okay. So what is it? That's what, 40% growth in equity over the last 3 years. That's good. Equity over 15% of the market cap. No, again, that's, I don't want to say that's a downside. It's almost like you're going to pay for what you get. That's kind of what it's like. You could say you're paying a lot for Nvidia for the last 2 years, but look at that stock, it keeps going up. Same thing with Tesla, same thing with Amazon. Some companies trade at 40, 50 times earnings, and they seem to always trade at 40 to 50 times earnings. Assets minus goodwill. If I didn't subtract the goodwill, then yes, it would be 2x liabilities. But without the goodwill, it's not 2x. Not the end of the world. It's not bad by any means. It's just not ideal, not perfect. The profit margin is over 10%, how we said, 25%. Cash and receivables. This is also a great metric. $1.5 billion on the balance sheet of cash and receivables, and their income, last year was $1 billion. So they got plenty of cash and receivables. I mean, again, it's not a downside. It's kind of a downside, but it's kind of justified because you're paying a lot. You're paying 50 times forward earnings. That's not cheap. That is not cheap. But you're getting good growth. You're getting good quality. You're getting a good moat. You're getting all these good things. You're getting super good financials, return on invested capital, everything you could possibly want. There's a bunch of stocks out there in the market where you pay 10 times, 20 times earnings, and that's great. But the quality of those companies is nowhere near this one. The financials are nowhere as good as this one. That's the trade-off. And I think Warren Buffett always says he'd rather pay more for the quality company than get a bad company for cheap, right? Because the strong companies can keep going and they justify those valuations. They grow into them. That's the trick. That's the key. They grow into those high valuations. And then when you look back, it looks like it wasn't anything. No dividend here. It's over 10 years old. They came out in the late 80s, and the free cash flow is good, growing at an average of 19% per year. as we will see right here, I like to look at the adjusted free cash flow that adjusts for stock-based compensation, which in this case should make these numbers look better. And I like what I see. I like what I see. From 20 this period here, the early 2000s up until 2017, was there a lot of growth there? No. Before 20, if we're talking 2017 and earlier, would I be as impressed? No, I wouldn't. But these last few years, the 1, 2, 3, 4, 5, 6 years now that they've put up these good numbers, and analysts have them doing good numbers for the next 2 years, that's where I'm impressed. I'm impressed. I mean, they've proven themselves, right? And it doesn't look like this is just like a one-time off thing or just a company that has some success for maybe 2 or 3 years and then they go back down. So I can't really find much wrong with this stock. And again, the stock's up. It's not like it's been through a major drop anytime recently. If that were to happen, I'd be a little bit suspicious. But I mean, look at this. I mean, look at this stock chart here. Do you really see a big drop? You don't really see a big drop. The biggest drop you see is like one of these, and it went from 186 to 134. I mean, you might not get a big 30, 40, 50% drop in this stock. You might just get a 10%, maybe a 15%, right? That's the way I look at it. I mean, look at the stock's up 400% in the last 5 years. I think there's a really great chance the next 5 years sees a similar return to that. So those are my thoughts on Cadence Design Systems. In the next couple of days or couple of weeks, I'll probably buy some more shares. And let's hope it doesn't shoot up too much more. But I think the future looks bright for this company. So if you guys agree or disagree or have any comments or you feel like I missed something here, please tell me down below. And I also have a Discord chat you can access in my description as well, or message me. You can find it on Discord under Stock Talk with Nico Criticos.